Back, the chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Chairman Henseling. Chairman Bernanke, I wish to begin by addressing one of your earlier comments in your opening when you said that the debate concerning other fiscal policy issues, such as the status of the debt ceiling, will evolve in a way that could hamper the recovery. My concern with that is that I believe that at $17 trillion and counting in debt, as we see in our national debt clock up there, when 6% of our federal budget is used to pay interest payments alone on national debt, I firmly believe that our sovereign debt should not go unpaid. But there's a tremendous difference between borrowing money to pay for an IRS Star Trek video and paying our sovereign debt. You see, I believe that it is disingenuous to say that the debate on the debt ceiling or the debt limit for this country will adversely impact us when, in fact, 2 years ago, the credit rating agencies came to us and said that if we don't have in place a systemic long-term path to reduce and address our debt, that we're going to be downgraded in our debt, in our ratings. It wasn't so much the debate on the debt that we had, it was the fact that we failed to take action to reduce in a systemic fashion, in a long-term fashion, our debt. Out of the debt ceiling debates that we've had in the past, we've come out with things as pay-as-you-go. I mean, the Gramm-Leach-Rudman Act. I mean, there have been good things to help us with that. So I think it's important that we acknowledge that having a healthy debate on the debt ceiling is prudent and responsible. With that, I also want to address a second part of your opening statement when you addressed the non-bank significant important financial institutions, specifically the implementation of the Collins Amendment. My concern with that, and going back to last week when Fed Governor Tarullo testified before the Senate Banking Committee, he told Senator Johnson that, quote, in regard to postponing and delaying the rules, as you testified before, on Basel III on non-bank financial institutions. However, he said that is to say that the Collins Amendment does require that generally applicable capital requirements be applied to all of the holding companies we supervise. I look at the Collins Amendment, and what concerns me is that I'm afraid your hands may be tied, in that we have two different types of financial institutions here. We have the short-term funding in the banks, and we have the long-term in insurance companies, and yet we're going to give risk-based capital requirements, expanded requirements based on general accepted accounting principles, which don't apply to insurance companies. We're going to increase the cost of insurance. And I come from a state where insurance is very important in Florida. And more importantly, we're going to probably result in a conflict between the McCarran-Ferguson Act and the implementation of a Basel III capital requirement for insurance companies. How do you feel that we can resolve that, or can we resolve that?
So quickly on the debt limit, I wasn't trying to make a policy recommendation other than to say that the last time around we did get a pretty big shock to consumer sentiment, and it was harmful to the economy. So I just hope that whatever is done, that it's done in a way that is confidence-inspiring. On insurance companies, we're going to do our best to tailor our consolidated supervision to insurance companies, but I agree with you that the Collins Amendment does put some tough restrictions that we're going to have.
Agree that we would have to legislate in order to give you, in other words.
Yes.
Thank you. Because I think that what we're at is, and one of the reasons for the delay is that you can't put the capital requirements that are as the minimum for banks as the minimum level capital requirements for insurance companies. As was pointed out yesterday in a Wall Street Journal opinion article, you're going to see the insurance companies that are now going to be held to a higher capital standard go more short-term debt. And now all of a sudden they may enter the banking business, which is going to be counterproductive to where we want to go with the correction that we're trying to do. So my question to you, I guess, as a result is that if we impose these the bank-centric capital requirements on insurance companies, would that have done anything to have saved AIG from its financial collapse of 5 years ago?
Well, there are a lot of things that AIG was doing that it couldn't do now.
Right.
Let's put it that way. On the Collins Amendment, it does make it more difficult for us because it imposes, as you say, bank-style capital requirements on insurance companies. There are some things we can do, but it is providing some.
Would it be safe to say in my last 20 seconds that the future is not too bright for the non-bank financial institutions in terms of having any reduction in their capital requirements?
Well, there are some assets that insurance companies hold that we can differentially weight, for example. There's some things we can do. But again, I think this does pose some difficulty for our oversight.
Thank you, and thank you again for your service.
Time of the gentleman's